Alright, welcome to the second lecture. So, we already went over what day trading is, and in this video, we're going to be talking about introduction to futures. So, I just want to give a quick little scenario. So, just imagine that you could trade the stock market without actually owning whatever asset you're trading. For example, gold. Imagine being able to trade gold without actually owning gold. That's exactly what futures trading allows you to do. So in this video, we're going to cover the basics of future trading. And by the end of this video, you're going to understand what futures are, why traders prefer to use them, and the different pairs that you can use. So if you're completely new to trading, don't even worry, because we're going to keep this very simple and beginner friendly. So the first question we need to ask is, what are futures? So futures is a contract, which is an agreement to buy or sell an asset at a future date or specific price. So what that means is you don't actually own the asset that you're buying or trading. And you're rather profiting from the price movement of that asset. So for example, if market goes up for whatever contract you buy, the contract value increases rather than owning the asset itself. And if whatever asset you're trading goes down, that contract value decreases. So futures is more or less kind of like speculating which direction price is going to go and profiting off that instead of owning the asset yourself. And there's future contracts for everything basically. There are indexes, so like NASDAQ, ES, which is what you should be trading. There's oil, gold, currencies, crypto, etc. So that moves us to the question, why do we want to trade futures rather than Forex or crypto or the whatever pair itself? And there's several reasons for this. The first one is that you can actually trade both directions of the market. So if you're predicting that a index, for example, is going to drop in value, you can short the market, which means you can make money off of it going down because you're buying that contract and predicting a lower price. So as we said, if market goes down, the contract value decreases. So you're banking money off of that. So another really good reason to trade futures is the 23/5 trading. So it literally almost trades 24 hours a day, except for a small 1 hour period where market changes sessions, and it is open every single day of the week except for weekends, so every weekday. Another reason is high liquidity. So futures contracts, a lot of the popular ones have huge trading volume. So like NASDAQ, huge trading volume, which is really good because it's has big moves. We can make a lot of money off of them, and entering and exiting trades is usually quick. We don't have to wait a long time. And then finally, high leverage. So futures allows traders to control a large position with smaller capital. So you can get much higher returns from your wins, but you can also risk more because of that. And then going over pairs to trade, I marked out some of the very popular ones, but I'd only look at the top two, maybe the top three. So we have NQ, which is NASDAQ, ES, which is S&P 500, GC, which is gold, and YM, which is Dow Jones. And the only reason I included YM is because of the correlation it has between NQ and ES, because they're all correlated pairs. They're all indexes, so they move relatively the same. But I really recommend you guys just stick to NQ, ES, or gold. So those are the futures pairs for the most popular indexes and commodity to trade. So I would stick with these. And before we wrap up the video, because there's honestly not much more to speak about, I do want to talk about micros versus minis. So this is contract sizing. We already know what contracts are, but what is contract sizing? So every futures contract comes in different sizes, and the sizing determines how much money you risk. So what that means is, let's say I want to trade NQ. Off of here, for example, let's say I want to buy. As you can see, I drag my take profit and stop loss. Just this is a random example. You can see that, okay, I'm risking 130 for 1,100. And by the way, I'm on a mini contract. So this is the standard contract of the futures pair that you trade, is the mini. So as you can see, there's a huge profit potential, but it usually also carries a larger risk. This is a bad example. Let's say like here, as you can see, it usually carries a larger risk. If you are not comfortable with taking that risk, you can trade micros, which if we input the same exact position with one micro, as you can see, it literally gets divided into 10. So micros is essentially just a mini, and a mini is, of course, the standard contract for a future pair. And a micro is just a smaller version of the contract. So 10 micros would be equivalent to one mini. As you can see right here, if we up that, it is the same value basically. So if you trade micros, it means smaller profit and smaller losses, but also lower capital requirements, plus easier to take partials. So that's the difference between micros and minis, and that's really all we have to look at. And that's basically all there is to futures trading. It is pretty simple. It can be complicated, but I tried to dumb it down in the simplest way possible because it's really not that complicated, but it is very important to know what they are and why we do trade them. So if you guys enjoyed this lecture, please leave a like, subscribe to the channel, and I'll be back with another lecture tomorrow. So I'll see you guys.